Hello and welcome to this month's market update. I'm joined by Tiffany Yong, member of our capital markets and asset allocation team. Welcome, Tiffany.
Hi, Carla.
So, Tiffany, in the US, the Twitter accounts have been ablaze, but can you tell us more about the Fed's announcement?
Sure. So in the recent FOMC meeting, the Fed has decided to keep its rates unchanged. There has been a divergence of opinions between the members of the Fed, where you have one group who thinks that inflation is weak and is concerned that inflation may undershoot the Fed's rate. Inflation has been running below 2% target for 3 consecutive months now, and they think that the Fed should keep its rates unchanged until the central banks are comfortable that inflationary pressures start to pick up again. And you have another group who is more hawkish, who thinks that the Fed should start raising rates sooner because of its concerns around employment being at full capacity. So the Fed committee will be monitoring inflation developments more closely in the coming months.
Great, okay, so wait and see there.
Yes.
And how about in Europe? Has there been a resurgence in economic activity after years and years of instability?
So positive economic indicators in Europe has been supportive of its recent recovery and has raised prospects of further tightening of policies and tapering speculations. So you have business confidence, which is over a decade high. You have unemployment rate, which is at 7.7% at post-GFC low, and GDP has been growing above expectations. But beyond that, the European Central Bank has decided to keep its accommodative monetary policy unchanged and have no urgency to raise rates or tighten anytime soon, because inflation has been weak and it's far below the bank's target of 2%.
Okay, so cautiously optimistic there.
Yes.
And how about here in the domestic market? We've seen the Aussie dollar go up, which is great for overseas travel, but
Yeah.
what impact does that have on markets? Is that likely to sustain?
Yeah, so the RBA thinks that Aussie dollar, with its recent appreciation, could weigh on its economic activities and inflation. However, inflation has been weak and the RBA is likely to lag the Fed in raising rates. We think that the current Aussie dollar may not be sustainable at this rate, simply because of two factors. So firstly, narrow interest rate differentials to the US, and secondly, Australia's economy is closely linked to China, so credit controls in China could flow onto the commodity export growth in Australia, which could then impact the Aussie dollar.
All right, so there could be a bit of pressure on the dollar.
Yeah.
So thank you very much for that update, and
you.
thanks to you for joining us.
Thank you.